Investors don't believe the Federal Reserve. The Fed has said they're going to raise US interest rates by around 1% and hold them there until at least the end of 2023. Investors are saying, nah. How do we know that? We know by looking at the Fed Funds Futures Market. I'm going to explain what the Fed Funds Futures Market is, break down how it shows that investors don't believe the Fed, and explain why it matters to the market and could have major implications for the health of the US economy. Let's get into it. In order to understand what investors expect from the Federal Reserve, you have to understand the Fed Funds Futures Market. Fed Funds Futures are financial futures contracts that are traded on the Chicago Mercantile Exchange, or the CME. Historically, the contracts were a way for traders to hedge their bets in case of surprise rate changes by the Fed. But today, the market is mainly a way for traders to bet on where the Fed will set interest rates. Traders make money if they buy the contract that aligns with the Fed funds rate in a given month. That rate is set by the Federal Reserve at meetings 8 times a year, on these dates. The 30-day contracts are listed for 60 consecutive months, so we can see what these traders are betting the Fed will do well into the future. The Fed has repeated in meetings and at press conferences that they plan to keep rates high.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive.
And they said in the most recent summary of economic projections that they expect to end 2023 with interest rates set between 5.1 and 5.4%. Investors clearly don't believe them. We can see this with the CME's FedWatch tool. It shows that based on the buying and selling of Fed Funds futures contracts, traders see less than a 2% chance the rate will be where the Fed predicts at year end. And we can see that contracts purchased through the end of the year show a 55% probability of a rate of 4.5% or lower. So why does this matter to anyone other than futures traders? Well, Fed Funds futures are a reflection of market sentiment. And if market participants don't believe the Fed, its policies are not as effective. Interest rate increases are designed to tighten financial conditions, which essentially means keep bond yields high and stock prices low. But since market participants don't believe the Fed will keep raising rates, stock prices have been rising and bond yields have been falling recently. That could push the Fed to raise interest rates even higher or hold them at higher levels for longer. And that could do more damage to the real economy. The Fed's rate hikes in 2022 more than doubled the prime rate, which sets the floor for the interest rate on personal and small business loans. It went from 3.25% in January to 7.5% in December. If the Fed moves rates even higher because traders don't believe them, that will price more consumers and companies out of the market for loans, and maybe price them out of business. A higher Fed funds rate also means higher interest rates for things like credit cards and auto loans, and traditionally, higher mortgage rates as well. This could mean increasingly worse economic outcomes for just about everyone, for an increasingly long amount of time. Brooklyn rapper Coda the Friend has some wise words for times of uncertainty. He says, "Fast money come and go. I'd rather take the slow route. Never judge. There's always something you don't know about." That's all for now. See you next time.